Lehman Brothers went bankrupt on September 15, 2008 because it combined extremely high leverage, massive exposure to collapsing US real estate, and an inability to secure new financing once market confidence evaporated. The failure resulted from several interconnected factors. Factor number one: huge exposure to subprime mortgages. Lehman accumulated billions of dollars in mortgage backed securities and commercial real estate investments. When US housing fell and mortgage defaults increased, those values lost substantial value. Point number two: excessive leverage. Before the crisis, Lehman was leveraged by roughly 30 is to 1. That meant a decline of only 3 to 4% in the value of its assets could wipe out almost entire of its equity. High leverage amplified losses dramatically. Point number three: reliance on short term funding. Much of Lehman's business was financed through overnight borrowing in the repo market. As lenders lost confidence, they refused to roll over these loans, creating a liquidity crisis. Point number four: loss of market confidence. Unlike a typical company, an investment bank depends heavily on counterparties trusting it. As rumors spread about Lehman's financial conditions, clients withdrew funds and trading partners reduced exposure, accelerating its collapse. Point number five: failure to raise capital or find a buyer. Lehman sought fresh capital and explored acquisition by Barclays and Bank of America. Bank of America instead acquired Merrill Lynch, while Barclays could not complete a deal in time because of regulatory constraints. Point number six: no government bailout. Earlier in 2008, the Federal Reserve System had helped facilitate the rescue of Bear Stearns by JP Morgan Chase. In Lehman's case, US officials concluded there was no legally and politically viable rescue without a private buyer willing to absorb the losses. The bankruptcy triggered panic across global financial markets. Banks stopped trusting one another, credit markets froze, and the crisis intensified rapidly. Within days, the US government rescued American International Group to prevent an even broader financial collapse, illustrating how systematic Lehman's failure had become. The fall of Lehman Brothers, the collapse that shook the global financial system. For decades, Lehman Brothers stood as one of the most prestigious investment banks on Wall Street. Founded in 1850, it had survived the American Civil War, the Great Depression, two world wars, the oil shocks of the 1970s, the dot-com crash, and countless financial panics. Its name became synonymous with American finance, global capital markets, and sophisticated investment banking. Few believed that an institution with over 150 years of history could disappear virtually overnight. But on September 15, 2008, that assumption was shattered. Lehman Brothers filed for bankruptcy, marking the largest corporate failure in American history. More than 25,000 employees faced uncertainty. Hundreds of billions of dollars in assets were thrown into legal limbo, and financial markets around the world descended into panic. Within hours, stock markets plunged, banks stopped trusting one another, and governments realized they were confronting the worst financial crisis since the Great Depression. Yet, Lehman's collapse didn't happen in a single day. It was the culmination of years of aggressive risk-taking, excessive borrowing, flawed assumption about housing prices, and a financial system built on confidence rather than certainty. When confidence disappeared, one of Wall Street's oldest giants failed with astonishing speed, triggering a giant reaction that nearly brought down the global economy. The story of Lehman Brothers is not simply the story of one failed bank. It is a case study in leverage, liquidity, market psychology, regulatory failures, and the dangers of believing that asset prices can only move in one direction. To understand why the world entered the financial crisis of 2008, we must first understand why Lehman Brothers collapsed. A Wall Street giant chasing bigger profits. By the early 2000s, Lehman Brothers had become one of the most profitable investment banks in the world. The American economy appeared strong, interest rates were relatively low, and a booming housing market was generating enormous wealth. Every year, home prices seemed to rise higher, convincing both investors and ordinary families that real estate was one of the safest investments imaginable. Lehman saw an opportunity to turn this housing boom into an unprecedented profits. Rather than simply advising companies or underwriting securities, the bank aggressively expanded into mortgage businesses. It purchased mortgage lenders, originated home loans, bundled thousands of mortgages into mortgage-backed securities, and sold those securities to investors around the globe. Pension funds, insurance companies, hedge funds, and banks all wanted these products because they offered higher returns than traditional government bonds while still carrying investment grade credit ratings. As demand grew, Lehman became increasingly dependent on the housing market. Every stage of the mortgage machine generated fees. The bank earned money when loans were issued, when they were packaged into securities, when those securities were traded, and when they were financed through short term borrowing. As long as home prices continued rising, the model appeared almost flawless. The success created a dangerous incentive. Strong quarterly earnings encouraged management to expand even faster. Shareholders demanded higher returns. Competitors like Bear Stearns, Merrill Lynch, Goldman Sachs, and Morgan Stanley were earning record profits, and no major investment bank wanted to be left behind. The result was a relentless race for growth, where caution increasingly became a competitive disadvantage. Taking greater risk was rewarded rather than questioned. Few executives believed the housing market could experience a nationwide collapse. That assumption became the foundation upon which Lehman Brothers built its future and ultimately its downfall. The housing bubble that fueled Lehman's rise. To understand why Lehman Brothers became so vulnerable, it is essential to understand the housing bubble that transformed the American financial system. During the early 2000s, low interest rates, easy credit, and widespread optimism encouraged millions of Americans to buy homes. Rising property prices convinced lenders, borrowers, investors that real estate was a nearly risk-free asset. If a borrower could not pay a mortgage, the house could simply be sold at a higher price. Banks began issuing mortgages to increasingly risky borrowers, including many with poor credit histories, unstable incomes, or little money for down payments. These became known as subprime mortgages. Instead of holding these loans on their own balance sheet, banks packaged thousands of mortgages together into mortgage backed securities and sold them to investors around the world. This process transferred risk throughout the financial system while creating the illusion that the risk had been reduced. Lehman Brothers became one of the largest participants in this market. It purchased enormous quantities of mortgaged, packaged them into securities, and also retained significant amounts on its own balance sheet. The bank believed that diversification across thousands of homeowners could protect it from major losses. Credit rating agencies assigned many of these securities as high ratings, with higher ratings, reinforcing the belief that they were safe investments despite being backed by increasingly risky loans. As housing price continued climbing, the strategy appeared remarkably successful. Every increase in home values made existing mortgage portfolios look stronger and generated even greater investor demand. Lehman responded by committing even more capital to residential and commercial real estate, steadily increasing its exposure. What few recognized was that the firm's fortune had become tightly linked to a single assumption that the American housing market could continue rising indefinitely. Once that assumption proved false, the entire structure supporting Lehman Brothers would begin to unravel. The leverage trap that magnified every loss. Lehman Brothers was not brought down simply because it owned risky assets. What transformed a difficult situation into a fatal one was leverage. In finance, leverage means using borrowed money to increase the size of investments. When asset prices rise, leverage can dramatically boost profits. When prices fall, the same leverage magnifies losses with equal force. By 2007, Lehman had borrowed enormous sums to finance its operations. The firm's leverage ratio approached roughly 30 to 1, meaning that for every dollar of its own capital, it controlled about $30 worth of assets. This structure generated impressive returns during the housing boom because even small gains on the massive asset base translated into substantial profits for shareholders. Executives were rewarded, investors were satisfied, and Wall Street viewed Lehman as one of the industry's strongest performers. The problem was mathematical, as much as financial. With leverage at those levels, only a small decline in the value of Lehman assets could erase a significant portion of its capital. A modest fall in housing prices was no longer just an inconvenience, it threatened the firm's insolvency. Losses that might have been manageable for a conservatively financed institution became existential for a highly leveraged investment bank. Lehman also relied heavily on short term borrowing through the repurchase agreement or repo market. Instead of funding long term investments with stable sources of capital, it continued borrowing money that had to be renewed every few days or even every night. This strategy was inexpensive while markets remained calm, but it left the bank dangerously exposed. If lenders ever questioned Lehman's financial health and refused to renew those loans, the bank would face an immediate liquidity crisis regardless of the long term value of its assets. The combination of massive leverage and dependency on short term funding created a fragile financial structure. It generated exceptional profits during good times, but it offered almost no margin for error. When the housing market finally turned, the very strategy that had fueled Lehman's success became the mechanism of his collapse. When the housing market turned against Wall Street. By 2007, the warning signs could no longer be ignored. Home prices across the United States stopped climbing and began to fall. For years, lenders had assumed that rising property prices would protect them from losses. That assumption quickly collapsed as housing prices fell. Millions of homeowners found themselves owning more on their mortgages rather than homes were worth. Delinquencies surged, foreclosures increased, and the value of mortgage backed securities began to deteriorate. For Lehman Brothers, the impact was severe and immediate. The securities it had accumulated during the housing boom were no longer viewed as safe. Assets that had once been considered highly liquid became difficult to value because buyers disappeared. Without active markets, no one could confidently determine what many mortgage related securities were actually worth. For every new write down raised fresh questions about how much hidden risk remained on Lehman's balance sheet. Investors' confidence began to erode, quarterly earnings weakened, and analysts started scrutinizing the firm's exposure to residential and commercial real estate. Credit rating agencies warned that further losses could lead to downgrades, while shareholders became increasingly concerned that Lehman had underestimated the scale of the problem. Rumors spread rapidly through financial markets, and each rumor made investors even more nervous. The crisis became self-enforcing. Falling asset prices forced Lehman to recognize losses, which weakened confidence. Weaker confidence caused lenders and investors to demand greater assurance or withdraw altogether. That, in turn, put even more pressure on the firm's finances. Unlike a manufacturing company that could continue producing goods during difficult times, an investment bank depended almost entirely on confidence of markets. Once that confidence began to disappear, Lehman's position deteriorated with alarming speed. By early 2008, it was clear that the problem was no longer confined to the housing market. The crisis had spread to the core of the global financial system, and Lehman Brothers found itself at the center of an increasingly dangerous storm. The race to save Lehman Brothers. The collapse of Bear Stearns in March 2008 sent a clear warning to every major financial institution. Within days, the Federal Reserve System helped facilitate Bear Stearns' acquisition by JP Morgan Chase, preventing what many feared would become a disorderly bankruptcy. Financial markets briefly stabilized, but one question remained unanswered. Who would be next? Attention quickly turned to Lehman Brothers. The firm attempted to reassure investors by raising new capital, selling assets, and insisting that its financial position remained sound. Senior executives argued that the market had overreacted and that Lehman's portfolio would recover once conditions improve. But confidence is difficult to restore once it has begun to disappear. Behind closed doors, government officials and banking executives searched for a private sector solution. Potential buyers, including Bank of America and Barclays, a takeover by either institutions could have prevented bankruptcy and reduced the risk of wider financial panic. Negotiations intensified over a tense weekend in September 2008 as markets waited for an answer before trading resumed on Monday morning. The talks ultimately failed. Bank of America concluded that Lehman's losses were too large, and instead of agreeing to acquire Merrill Lynch, the talks ultimately failed. Bank of America concluded that Lehman's losses were too large and instead agreed to acquire Merrill Lynch. Barclays remained interested, but British regulators were unwilling to approve the transaction without shareholder approval and guarantees that could not be arranged in time. Unlike the rescue of Bear Stearns, the US government didn't provide a backstop that would make the acquisition feasible. As Sunday night came to an end, the outcome became unavoidable. Without a buyer, without sufficient new capital, and without government support, Lehman Brothers had exhausted its options. When financial markets opened on Monday, September 15, 2008, one of Wall Street's oldest and most influential institutions would officially enter bankruptcy, sending shockwaves through the global economy. September 15, 2008, the day the financial system froze. In the early hours of September 15, 2008, Lehman Brothers filed for Chapter 11, bankruptcy protection for the United States. Bankruptcy protection in the United States. With more than 600 billion in assets, it became largest. September 15, 2008, the day the financial system froze. In the early hours of September 15, 2008, Lehman Brothers filed for Chapter 11 bankruptcy protection in the United States. With more than 600 billion in assets, it became the largest corporate bankruptcy in American history. The announcement stunned global financial markets. Investors had assumed that, as with Bear Stearns months earlier, the government would or another major bank would step in to prevent such a collapse. That assumption proved wrong. When markets opened, panic spread almost immediately. Lehman's stock became worthless, and institutions around the world rushed to determine their exposure to the failed investment bank. Thousands of contracts involving derivatives, loans, securities suddenly became uncertain. Banks that had routinely lent money to one another began questioning whether their counterparties might be the next to fail. The result was severe liquidity crisis. Financial institutions stopped trusting each other, and short-term lending markets and the lifeblood of the global banking system began to freeze. Businesses that depended on banks for daily financial and financing found credit becoming scarce. Investors fled risky assets in favor of cash and government bonds, causing stock markets across North America, Europe, and Asia to decline sharply. The shock quickly spread beyond Wall Street. Companies delayed investments, consumers reduced spending, employers began cutting jobs. What had started as a crisis in the US housing market was now evolving into a global financial panic. Within days, governments and central banks recognized that the failure of Lehman Brothers had fundamentally changed the crisis. The objective was no longer simply managing losses, it was preventing the collapse of the entire international financial system. The bankruptcy of Lehman Brothers became the defining turning point of the 2008 financial crisis. It demonstrated how interconnected modern finance had become and how the failure of a single institution could trigger a chain reaction that threatened economies across the world. The global domino effect. Lehman Brothers' bankruptcy didn't remain an American problem for long. Within hours, it spread, affecting every major financial center. Banks in Europe held mortgage-related securities linked to the US housing market. Asian financial institutions depended on American dollar funding. Investment funds around the world had exposure to Lehman bonds, derivatives, or trading relationships. When Lehman failed, uncertainty spread across the entire global financial network. One of the major casualties were the money market industry. The Reserve Primary Fund, which had invested in Lehman debt, suffered heavy losses and broke the buck, meaning its share price fell below $1. Investors who had considered money market funds to be almost as safe as bank deposit rushed to withdraw their money. This sparked fears that even the safest corners of the financial system were no longer secure. Pressure mounted on other financial institutions. Insurance giants American International Group faced enormous losses from credit default swaps that issued mortgage-related securities. Only one day after Lehman's bankruptcy, the US government authorized an emergency rescue of AIG, concluding that allowing another major institution to fail could trigger an even deeper financial collapse. Credit markets seized up. Businesses that relied on short-term financing struggled to borrow. International trade slowed because banks became reluctant to issue trade finance. Stock market experienced violent swings, while pension funds, mutual funds, and ordinary retirement accounts lost substantial value. Companies that had little direct connection to the housing market found themselves unable to obtain the financing needed for routine operations. The crisis soon reached the real economy. Factories reduced production, consumer spending weakened, unemployment rose, and governments around the world launched the extraordinary rescue programs. Central banks injected unprecedented amounts of liquidity into financial markets, while national governments recapitalized banks and introduced stimulus packages worth hundreds of billions of dollars. What began as the collapse of a single investment bank had evolved into the worst global financial crisis since the Great Depression. The lesson that changed global finance. The collapse of Lehman Brothers permanently changed the way governments, regulators, and financial institutions viewed systematic risk. Before 2008, many believed that large investment banks could manage their own risk through sophisticated financial models and market disciplines. Lehman's failure demonstrated that these assumptions were deeply flawed. A single institution, if sufficiently interconnected and highly leveraged, could threaten the stability of the entire global financial system. In the years that follow, governments introduced sweeping financial reforms. Banks were required to hold significantly more capital to absorb losses and maintain larger liquidity buffers to suffer periods of market stress. The regulators imposed stricter stress tests, including major financial institutions, to demonstrate that they could withstand severe economic downturns. Oversight of derivatives markets increased, and authorities developed new resolution frameworks designed to wind down failing financial institutions without triggering another systematic panic. The crisis also transformed central banking. During the panic, central banks discovered that acting as lenders of last resort were no longer sufficient. They expanded emergency lending facilities, purchased government and private sector assets on an unprecedented scale, and coordinated closely across borders to stabilize international financial system. These extraordinary interventions became defining features of crisis management in the decades that followed. For investors, the events of 2008 reinforced timeless principles. High returns often conceal equally high risks. Excessive leverage can amplify profits during prosperous periods but becomes devastating when markets reverse. More importantly, confidence itself is a critical financial asset. Once markets lost trust in an institution's ability to meet its obligation, liquidity can disappear far more quickly than balance sheets or financial models can even predict. Lehman Brothers survived for more than 150 years, overcoming wars, recessions, and economic upheavals. Yet it was ultimately undone, not by a single catastrophic event, but by a combination of excessive leverage, concentrated exposure to a housing bubble, dependence on short-term funding, and a collapse of market confidence. Its bankruptcy remains one of history's clearest demonstrations that in modern finance, trust can take decades to build and only days to disappear. Conclusion: the bankruptcy that redefined modern finance. The fall of Lehman Brothers was far more than bankruptcy of a single investment bank. It marked the moment when hidden weaknesses within the global financial system became impossible to ignore. Years of easy credit, excessive leverage, complex financial engineering, misplaced confidence had created an environment where extraordinary profit masked extraordinary risk. When the housing market turned, the entire structure began to collapse. The event of 2008 exposed a fundamental truth about modern finance. Markets are built not only on capital but on confidence. Banks lend because they trust they will be repaid. Investors buy security because they trust valuations are credible. Businesses expand because they trust credit will remain available. Once that confidence evaporates, even institutions with long histories and global reputations can fail with astonishing speed. The consequences extended far beyond Wall Street. Millions of people lost their jobs, homeowners faced foreclosures, businesses closed, retirement savings declined, and governments committed trillions of dollars to stabilize the financial system. The crisis reshaped banking regulations, influenced monetary policy for years to come, and altered how investors, policymakers, and economists think about systematic risk. More than a decade later, Lehman Brothers remains one of history's most studied financial failures. Its collapse is examined in business school, economics departments, central banks, and boardrooms because it illustrates how incentives, leverage, liquidity, and psychology can combine to create a crisis of historic proportion. It serves as a reminder that financial systems can appear strong on the surface while becoming increasingly fragile underneath. The story of Lehman Brothers is therefore not just about one bank that failed. It is about dangers of unchecked risks, the consequences of overconfidence, the speed with which confidence can disappear once fear takes hold. Understanding why Lehman collapsed is essential to understanding the global financial crisis of 2008 and why its lessons continue to influence the world economy today.